if you understand what gold is saying, it is a warning. And it's a warning that you had better heed and that you better react to. You better get out of dollars. You better get into gold and silver. That's what the central banks are doing, right? Follow their lead, right? They ought to know. They're like the insiders in the fiat money system. But I want to start off today's podcast also talking about gold, because gold is one of the big stories of the week. In fact, it's one of the big stories of the month, because Friday was the last day of the month, trading wise. I mean, in fact, we're still in August, right? It's the 30 today, 31st. But by the time the market reopens on Tuesday, we're in September, and so the month of August is over, and gold closed at not only its highest price ever, but it was the highest close on a daily basis, on a weekly basis, on a monthly basis. Gold, I think, is finally getting ready for the next leg up. In fact, it probably started that leg up on Friday by going through the highs. But now I think we've got clear sailing to get up to 3,500. I think we'll pass that relatively quickly. In fact, I'll take a look at where we're trading right now. Early Sunday evening, so Asian trading is just kind of kicked off. And in the gold market, let me pull that up. Yeah, no, gold's down about 90 cents, 3,448. A few minutes ago, it was trading above 34.50. Silver also on Friday. Silver closed at a 13-year high. We came within 10 cents of $40. Right now, we're trading at 39.72, which is up about a dime from where we closed on Friday. But both gold and silver looking very strong, technically, fundamentally. The dollar was also weak on the week. Dollar index closed back below 98, about 97.80. So weakness in the dollar also working to help the gold market. And so when Trump forces the Fed to cut interest rates because we want lower rates, what message is he sending to the lenders, right? There's an expression, it takes two to tango. And that's true with borrowing. You need a lender, right? And so there are two parties here. There's the borrower and there's the lender. Yes, as the borrower, America wants lower rates. But what about the lenders? Do they want lower rates? No, they want higher rates. Why do they need higher rates? Well, because there's risk, higher risk because we have so much debt. But if you are lending the U.S. government money, you're not doing a favor to the government. You're expecting a return, right? You're taking some risk, even if you think it's modest, because you think the government is, pristine credit, which it doesn't have. I mean, our debt has already been downgraded. I mean, and it could get downgraded a lot more. But when you're loaning money, you expect to get a return. Well, if the Fed lowers interest rates, the rates are going to be below even the official rate of inflation. See, Trump says we should have 1% interest rates. Well, inflation, even the way the government measures it, is at least 3%. Well, how are we going to have 1% interest rates when inflation is 3%? That means if you loan the government money, you lose 2% a year. Well, who the hell wants to do that, right? Why make a loan when you can't possibly profit from the loan, that you're going to be worse off? Why part with your money? When you loan your money out, you could have spent the money yourself, but you loaned it to somebody else, and now they're using your money. Well, they're supposed to pay you for the privilege of using your money. If they're not going to pay you, you might as well use the money yourself. The reason you make a loan is to get interest, right? Because then you can spend the interest and the principal later and end up with more. But if you're going to end up with less, if you're going to loan money and you're not even going to get paid interest that equals the rate of inflation, then what the hell are you loaning the money for? So you could buy less in the future? You're supposed to loan money out so you could buy more in the future. That's why you wait. Hey, I'm going to wait. I'm not going to spend my money now. I'm going to loan it out, and then I'm going to spend it later with all the interest I earn. I'm going to buy more stuff. But if you're not going to get enough interest to equal what you lose to inflation, then no, you're not going to loan it out. Either you're going to find somebody else to loan it to who will pay you more, or you'll just spend the money yourself, right? And so when the Fed is going to cut rates, it's going to scare off the lenders, especially the ones that are outside the United States, because they pay particular attention to the exchange rate of the dollar. Let's say the dollar is falling by 5 or 10% a year. Could be falling by a lot more than that. If you're in Europe, are you going to lend the U.S. government money and collect 2% interest if the dollar is going to lose 5 or 10% of its value against the euro? Of course not. You're going to take a hit, right? So, yes, Trump wants lower interest rates to save us money, but the lenders won't lend to us at lower interest rates because they don't want to lose money. That is the box that we're in. So the only way that we can have lower interest rates in America with soaring deficits and rising inflation and a weak dollar is if the Fed does all the lending. That means massive quantitative easing. And that means runaway inflation. And that's really what the Trump administration is pounding the table that it wants. Even though Donald Trump ran against inflation, Biden inflation was bad, I'm going to wipe out inflation. The policies that he is advocating are the most inflationary policies in U.S. history. This is the reality of the situation. Donald Trump wants massive deficit spending to be financed by, debt monetization by a Federal Reserve that he controls. So he wants to officially make America a banana republic. The only problem is we don't really have any bananas, right? So we're a banana republic without bananas, which may mean we're worse. But this is the direction that we're headed in. And that's why people are selling the dollar. Now, right now, people are walking away from the dollar. By next year, if we go back to QE, they'll be running for the dollar as fast as they can. And so that's why, you don't want to wait, right? Read the writing that's on the wall, right? Newmont Mining isn't going to be the number one performing gold stock stock in the S&P by accident. When precious metals stocks are the number one performing stocks, certainly there's no sector that's beating precious metals this year. That's not a good thing, right? It's not a healthy market when precious metals are the leading sector, right? And, it's getting no coverage, too. That's one of the things. If you watch the Peter Schiff podcast, yeah, you know about the gold stocks. I've been talking about them for years now. But the mainstream financial media, they're not even talking about them now. They barely talked about them yesterday as they're making new highs. They barely talked about gold as gold is making all-time record highs. I still remember when I went on CNBC back when they still had me on. I hadn't been on like 10 years. I don't know. I can't remember when I was on. But when I used to be on every week, but when I first started going on, I was on Squawk Box, and the host was this guy, Mark Haynes, who passed away quite some time ago now. But the first time I was on, of course, I discussed the price of gold, and I think it was still below 300, or maybe it was in the low 300s. I forget. But I came back, I don't know, a few weeks later, and I'm in the studio again talking to Mark Haynes. And I said, Mark, gold's up about $40 since the last time I was in this studio. And his response to me was, who cares? Who cares about the price of gold? And, he mentioned a number of things where he cares about the price. But he says, I forget, maybe it was bread or oil, I forget. But he said, why should I care about the price of gold? Right? He is the anchor in a financial news show. It's supposed to be focusing on finance, investing, economics. And he says, who cares about the price of gold? How could you not care about the price of gold? Only if you just don't understand what gold is. Gold is money. It's you're a show about money. How could you not care about gold? And when the price of gold is going up, especially like this, it is a warning. It is telling you that there's a problem, right? I mean, even Alan Greenspan, I talked about this. He used to use gold as his primary reference to know whether or not he was too loose or too tight. He used to say that if gold gets up near 400, I'm too loose. If it goes below 300, I'm too tight. Now, what does that say? Look where we are now, 34.50. We've been too loose for decades based on Greenspan's metric. But the gold is the most important price. It's not just a precious metal. It's not just a commodity. It's a monetary metal. Central banks are holding gold for a reason, right? How could you say, oh, I don't care about the price of gold? Well, what about all these central banks that are hoarding all this gold? Don't you think that's significant? Because, they're not stockpiling other commodities. They're owning gold for a reason. It is the single most important price out there. And right now it is screaming that there is a huge problem. There is something rotten in the state of America. And that's what you're seeing in the gold market. And, I'm sure that mentality still exists today. The same one that Mark Haynes had, even though he's not around anymore. I think that idea that who cares about the price of gold, right? What's the big deal? It's nothing, right? It's just a rock, right? They care a lot more about Bitcoin than they do about gold. But if you understand what gold is saying, it is a warning. And it's a warning that you had better heed and that you better react to. You better get out of dollars. You better get into gold and silver. That's what the central banks are doing, right? Follow their lead, right? They ought to know. They're like the insiders in the fiat money system, right? So if you see in a company, if all the managers are dumping their shares, they might know something that you don't. Well, this is basically what's happening. The managers of the fiat monetary system are dumping their dollars. They want out. And they're buying gold. They're not buying other currencies. They don't want another fiat currency. They want real money. You should do the same thing. And the same thing is happening with investors. Not necessarily in gold, but they're dumping their U.S. shares and they're buying back their own stock. Right? That's why, my dividend payers fund is almost up 40% on the year now. It's at 39%. It's on the high of the year because value international dividend paying stocks, that's where people are putting their money now. That's where when they sell in their U.S. stocks and they sell their dollars, they're bringing their money home and they're buying value. They're buying income, right? They're buying these dividend paying stocks. I think we're still early in this trend. So again, you want to go to the Europe Pacific website, Europac.com, and talk to my representatives about how we can help build a portfolio for you, manage a portfolio of foreign stocks, value and dividend paying stocks. And we also have portfolios where we manage in gold mining stocks, which, we're early in this bull market. I think we're just starting the second leg, right? The first leg was just a pure wall of worry. Nobody was investing. Everybody was scared. Everybody thought gold was about to crash. So nobody wanted to buy gold mining stocks because no one believed in the rally. I think now you're getting institutions finally starting to recognize that the rally was real, that gold prices aren't going to crash, that maybe $3,400 gold is the price. And that means gold mining stocks are way too cheap because they're priced for much lower gold prices because everybody expected gold to collapse. But eventually, not only are investors going to realize that gold's not going to crash, but that it's going much higher. And that's when you're really going to start to see the bids coming into these gold stocks. But as I've been saying on my podcast, the action over the last few weeks has been great because the gold stocks are now leading the metal. Gold is really barely up over the last 4 months because we just barely took out the high. But during that time period, gold stocks are almost up 30%. Get about a 30% move in gold stocks as gold itself was going sideways. Well, now gold is broken out, and I expect another big up move. And if gold stocks were this strong with gold going sideways, imagine how much stronger they're going to be when gold resumes its uptrend. Right? So I think that by the end of the year, we could be up well over 100% on the GDX for the year. We still have a lot of time left in 2025, and this is already the best year that these gold stocks have had probably since the 1970s, I guess, but there wasn't a GDX back then. So it's probably the best year in the history of that ETF, right? And if all the ETFs, it probably gets the least amount of coverage. So go to the Schiff Europac website, europac.com. And again, you can buy my mutual funds, the 5 mutual funds. You can buy these at any discount broker. And we have information as well as the ticker symbols and prospectuses on these funds. You can get it all on my website at europac.com when you go into the funds. But, it's not too late. We're still very, very early in the scheme of things. Even though I've been buying these stocks for a long time, you can say, how could it be early? It's just early in this bull market. I was buying it before the bull market, although there are a lot of stocks that, are 10 times what I bought them years ago. But that's not the average stock. There are some stocks that have done great, but a lot of stocks have gone sideways. But I think that's all about to change. Just about every stock that I own in the sector hit a new, not only a 52-week high on Friday, but a decade high or more. So we're seeing across the board strength in these stocks. The one thing that still hasn't moved are the little ones, the real juniors, although they're starting to move, but they have a long way to go. I think that's going to really supercharge the Euro-Pacific Gold Fund, because we have a really nice position established in those smaller companies that are very, very hard to buy.